Hi everyone, my name is Robin Speziale and I'm the national best-selling author of a book called Market Masters. In this video, we'll be discussing value investing versus growth investing. And myself personally, I've been investing in the stock market now for over 12 years. And I've always been a growth investor, but more importantly, a growth at a reasonable price investor, which is GARP. We're going to be talking about a lot of those principles that make up growth investing, some of the pros and cons, but also compare that closely with value investing. Value investing, I find you can do really well in certain periods of the market. So after major crashes like the financial crisis, as well as something that occurred in 1987, there was a major crash then. Of course, the Great Depression. There's been other cycles as well. Whenever you have a bear market, or a market that's gone down 20%. This is also a good time for value investors. You can pick up stocks like Visa sometimes 20% off. The only time when I saw large cap, big notable companies like Visa, like Royal Bank of Canada, like Wells Fargo drop 50% or sometimes greater was the financial crisis of 2008, 2009. And again, those are opportune times to become a value investor, pick up cheap stocks. But for the most part, I just love picking these growth companies that are growing at 15% earnings per share, net income, revenue, year after year after year. And so let's get into it now, guys. So value investing versus growth investing. So first, what's value investing? Value investing, it means value investors seek out and invest in undervalued stocks trading on the stock market. And undervalued here simply means that those quote unquote value stocks are trading below their intrinsic value, okay, the actual worth of a business. So that mispricing a stock's price trading below its intrinsic value price can occur for a variety of reasons. Namely sentiment, perception of the company, unusual or short-term events. Perhaps they missed a fourth quarter earnings, and broad market declines. Intrinsic value is a culmination of a company's brands, tangibles, intangibles, future earnings, and competitive advantage, among other things. Intrinsic value is seen as a better gauge of a company's worth than merely its book value, which is just assets minus liabilities, which doesn't adequately account for the true worth of a company. Value investors invest in these undervalued or mispriced value stocks in the anticipation that their market prices will revert to their mean or go back to their intrinsic value. But inherent in value investing is the risk that reversion to the mean does not occur in a short time frame, and the stock's market price may continue to decline or be volatile. The biggest risk, though, is what is referred to as a value trap, in which a value investor misjudges a stock's intrinsic value, such that the company's fundamentals completely deteriorate and, in effect, validate the stock's lower price. For this reason, value investors must identify a catalyst, for example, a change in management, or a set of catalysts in each value stock to determine whether they will actually revert back to their intrinsic value. And so, value investors are always challenged with not only finding these mispriced stocks where they feel, okay, stock A, it's trading at a price at $6, but I've done my research, I've looked at the balance sheet, and I see they have, real estate, which is, it's not correctly stated in the balance sheet. It actually has a higher value than that. They have these patents, they have this great technology. And I believe that the $6 stock, company A, should actually be trading at $10 per share. Because of all this research that I've done into the actual company, that is the intrinsic value. It should be $10 per share. So that value investor would buy the stock at $6 and expect it to then rise to $10 per share. And what value investors tend to do is that once the stock does revert to that intrinsic value or mean, whatever they call it, they'll then sell that stock. And Warren Buffett has called this, picking up these cigars on the street, these discarded cigars, and there's a couple of smokes left, but that's about it. Now, what I like about growth investing is that you can theoretically start investing in a company at an early stage. If it's a micro, small, or mid-cap company, smaller in size than a company like Amazon, and you can hold that company throughout its growth. And this can be many years of high growth, high price appreciation in the stock. And so growth investing isn't just buy stock at $6 per share. If it goes up to $10 per share, great, then you sell it. Growth investing is it's a long-term game. So we talked about value investing. Now let's talk about growth investing. This is a value versus growth investing video. So growth investors invest in stocks that have higher than average return potential compared to other stocks in the stock market. That means growth investors use criteria such as revenue growth, earnings growth, return on equity, and return on invested capital, among other metrics, to inform their investment decisions. These criteria can be augmented by strong management that is skillful at capital allocation, such that those managers can maintain high growth rates for as long as possible. The law of large numbers often means that growth stocks' compound returns do lower over time. And so the once high growth achieved by those growth stocks can stall. That is why growth investors tend to allocate their money into new growth stocks that should experience high multiple expansion into the future, at least until they too face an abatement in high growth compound returns. The risk inherent in growth investing is that growth investors can chase hot stocks, effectively buying high and selling low, or simply rack up high commission fees from a higher than average turnover in their portfolio, always chasing these quote unquote hot stocks and just buying and selling until you find the right one that gives you a good price appreciation within a week, which isn't how you should invest in growth stocks. You should definitely look up something called growth at a reasonable price, which mixes investing in a small company that has a high growth rate, but you can buy it at a reasonable valuation. And Peter Lynch explained this really well with what he called the price to earnings growth ratio, PEG. So you take the price to earnings multiple as a numerator, and then you divide by the net income growth, annual net income growth. That would be the denominator. So for example, if company A has a price to earnings multiple of 40, you shouldn't just say, that's too overvalued, it's too high a price to pay for a stock and move on. What if the annual growth rate of its earnings is 60%? So you take 40 divided by 60, and you get a number under 1. And this would be a favorable multiple to someone like Peter Lynch. But you'd also have to do much more due diligence about the company, its business model, products, services, competitive advantage, the state of its financial balance sheet, etc. So the risk-reward concept argues that growth investors are rewarded for their assumption of greater risk in the market. Usually growth stocks exist in the microcap, small cap, and mid-cap segments because, as previously mentioned, growth can stall due to the law of large numbers. That is, compounding returns, they just can't be high forever. It's very hard for a company like let's say Amazon, which has crossed the $500 billion mark. It's hard for Amazon to double again within a short period of time, because to double, that would mean going from 500 billion to 1 trillion, and then doubling from there is just very, very, very tough. So that just means less returns for the investor who buys a very late stage, mature, large company like Amazon. Eventually, those growth stocks can become large, steady stocks, and which start paying a dividend, and which you can hold in a portfolio that is a lot more stable. And my strategy is, again, we've compared here value investing versus growth investing. I prefer growth investing. I like to invest in a solid group of quality companies that are growing over time, and my target annual compound return is 15%, 1.5. The problem I find with value investing, it's incredibly stressful to find these mispriced stock opportunities. And then, once they've achieved your target price, or perhaps they get bought out, which tends to happen with these very mispriced stocks on the market, you're forced to go out looking for other value stocks. Whereas if you find a good group of quality growth companies, you can keep them in your portfolio for as long as possible, as long as they're performing. So I really hope this helps, guys. And I just want to say happy investing. If you have any questions, you can email me at r.speziale@gmail.com or check out my website for a lot more posts on investing at robinspeziale.com. Thanks, guys. Talk soon.